I don't think we're in Kansas anymore, boys. Welcome back, everyone, to Tandem Talk, episode 20. This happens to be our 5th anniversary episode, and now for something completely different. And if you get that reference, let me know, and I'll do a client event for you. As always, I'm joined by our investment team of, to my left, Ben Carew.
Hey, how's it going?
To my right, Billy Little.
Hello, everyone.
And out of my sight, Jordan Watson.
Good to be here.
So, a lot has happened since episode 19 was recorded in February, and yet we're sort of in the same place, aren't we? And so I've been given a few talks lately that we've titled Through the Lens of Tandem, and I thought it would be good to bring that to our 5th anniversary, just to talk not about the events themselves, but about the events and how we react, respond, whatever, through the lens of Tandem. So since Liberation Day, we've seen a lot. We've seen a lot of market volatility. We've seen interest rates move lower and higher and lower again. And so I just want to talk briefly, if anybody has anything intelligent to say about the volatility itself that we've experienced, and then I'd like to go into our mantra of how we can help keep clients invested through all this. So anybody jump in?
No, I think you're spot on it. We have essentially gone nowhere in the past 3 months, 4 months, since the start of the year, basically. There's been a lot of noise, a lot of movement in all financial assets, but at the end of the day, we've gone essentially nowhere on price, and valuations are still where we saw them previously,
Which is high.
So if you fell asleep 3 months ago and you woke up, nothing has changed.
Let me ask you something about that. Maybe you were going here, Ben, but valuations are still high. Now, for the record, as of this recording, filming, whatever we call this, the S&P is down slightly year to date.
Yeah, I think
a couple
down
percentage
a
points.
percent or two.
Right,
including
okay.
today.
But are we as expensive or are we more expensive? Have earnings expectations come down because of tariffs and the like?
So you definitely. Oh, you go ahead, Billy.
I'm sorry. We're essentially through Q1. Coming into this year for calendar year 25, we were looking at 270 S&P 500 earnings. So strip out Q1 because we're basically through Q1 now. So looking out the next 4 quarters, starting with Q2, we're at 270 on earnings. So you're essentially exactly where you were. Earnings have not moved. Earnings have come down a little bit, but looking Q2 out to through Q1 next year, so next 4, those estimates are the exact same as where we were coming into the year for calendar 25, if that makes sense. So on a valuation, no, you're exactly where you were, which is 22 times earnings for the next 4 quarters.
For the S&P.
For the S&P 500.
I mean, that's on the high end over the past 3 years, 4 years, 5 years, 10 years, 20 years, whatever time frame you want to look at. That is elevated. Now, I think what gets more interesting when you're talking about the multiple on the market right now is if you believe earnings are actually going to come in at 270. I think I saw in FactSet for this year, estimates are still supposed to be about 264 in terms of earnings per share on the S&P, which puts us right at that same multiple. And that's 10% year-over-year earnings growth. So do you really think that the S&P is going to grow earnings 10% in this environment? And I think that's where the question gets interesting. Because if you don't, then we're going to be significantly more expensive. I think Goldman has estimates out for year-end earnings growth of 3%. So I think that gets to earnings per share of about 247. And if you slap a multiple of 20 times, which is about the 5-year average right now, then you're talking about an S&P at 4,900. That's significantly lower than where we are right now. You want to use a 10-year average, that takes it down to 4,500. And so I think that really regardless of whether or not estimates do change, we're still elevated, but we're even more elevated if you start thinking about earnings growth just contracting a little bit. And that was 3% earnings growth. That wasn't even an earnings contraction, which is normal in a slowdown or a recession.
Yeah,
Now-
and on the earnings front, what's interesting about this quarter of earnings is I think we're 3/4 of the way through earnings season, and you've had a number of companies reaffirm guidance for full year, but the beat rate's actually still pretty elevated relative to history, right? So you've got companies that are beating earnings this quarter, but are reaffirming guidance for the full year. So technically, what you could look at that and say is, well, is that technically them actually lowering guidance for the full year because they beat this quarter? It's just an interesting trend that you've seen so far this quarter. I think what's been kind of nice is at the beginning of earnings season, we kind of thought that a lot of companies might be withdrawing guidance. I think you saw maybe Delta or United come out.
United gave 2 sets of earnings.
Yeah. So there was sort of worry that, okay, a lot of companies are going to start pulling guidance for the full year. I mean, during COVID, hundreds of companies were doing so. And kind of looking on the bright side, I think maybe 5 to 10 companies have just completely pulled guidance. So it's been much less. But the trend has been interesting about reaffirming, even though they beat.
See, I feel like I saw an article. I don't remember if it was an FT or if it was somewhere else, but it was basically saying that we are at levels only seen during the financial crisis and during COVID in terms of the spread between downward revisions and upward revisions. So I hear you on companies reaffirming their guidance, but clearly there is an overwhelming trend of downward revisions at the individual company level. And that's alarming to me. I mean, that's definitely concerning when it comes to market health.
So let's bring this back to us and through our lens, if I can. So when we met last time, if memory serves, we spent a minute or two talking about the valuation of the largest capitalized stocks in the S&P 500 and how the index, as we think of it, which is a cap-weighted index, wasn't truly reflective of the average stock in the index, and that the real overvaluation was in the very largest of companies. How has that changed?
You definitely saw those companies get beat up. I think in the Tandem report that just came out, we talked about it a little bit in there about whether or not the market was selling off due to tariffs or global uncertainty or whatever it was. And one of the things that we said in the Tandem report at the time was, hey, this is maybe, just maybe, the pendulum swinging back. And so you saw the Mag 7 really get beat up, especially through the first couple months of the year. I think in April, specifically around Liberation Day, correlation sort of moved to 1 and everything started to get sold off. But I mean, this year there were places, or at least in Q1, there were places in the market that were doing quite well, while the market itself was not doing that well because of that overweighting of the Mag 7 that we were talking about.
Fair enough.
Last call.
And you've seen it in the equal weight. Equal weight has outperformed the market capped S&P 5 or the regular S&P 500 by a couple hundred basis points this year, performance-wise. So you've seen that performance broaden out, which is a great thing. I don't think things like this get resolved in a month or 2 months or a quarter. I think it can take a lot of time for the breadth to expand much wider than it is now. It's still fairly narrow.
Even though we've been liberated?
Even though we've been liberated.
Okay. So I want to ask a question. In virtually every piece of material that we publish, we state that it is our objective to help clients stay invested through situations just like this. So I don't want to talk about our investment experience or performance or anything of the kind, but let's talk about what we look at. I'm often asked how we position ourselves for markets like this, which tells me that the questioner doesn't really know what we do, but let's make sure that our listener and our audience does know how we think about turbulence like this.
It's opportunistic.
Yeah.
I mean, I don't know that we, to go back to the positioning question, it's not that we're positioning for any type of market. We're just doing what our...
I would argue that we're already positioned before this happens.
Correct, but that wasn't hey, we came in on
Not a market
January 1st and
Right.
said,
Agreed.
market's going to fall 10% or 15%, let's position this way. It was all a byproduct of our process. Always is, always will be. That happened too, and it often does, When things are more expensive, more stocks to sell than buy, cash goes up, and we've got the patience to take advantage of opportunities.
I think that what always stands out to me during an environment like what we just went through, which was very volatile in Q1, very volatile to the downside in early April, and then a market that just ripped back in the back half of April, is our unemotional discipline. I had the chance to go hear Bill Ackman speak at the Citadel a couple weeks ago. And one of the things that he talked about there was that as humans, we're biologically incentivized to run for the exits when everybody else is running. Because thousands of years ago, if we're all running in the same direction, it's probably a good thing to join the crowd and run with them because the enemies are coming, whoever they are, whatever they are. And so when everybody's 401k is dropping, it's the same response, right? It's that fight or flight response. And it's the wrong one in this realm, right? When it comes to investing, moving with the crowd like that can be really costly. And so you have to approach it without emotion. And I think time and time again, whether it was Q1, us not really selling off, the market selling off, and us not having a whole lot of activity as a result, or early April, the market's now down a lot and we're putting cash to work at the strategy level because we're getting the signals that we need out of our model, or not that we need, but we're getting the signals that we had out of our model to put money to work. Same thing was true throughout 22. Same thing was true throughout COVID or throughout 2018, which was also sort of trade war induced at the time. I think time and time again, you see the lack of emotion in our process benefits our clients, in my opinion.
I would agree. I think that's well said. I would say it slightly differently, not to disagree with Mr. Ackman, who's way more qualified to have intelligent opinions than I am. But I would say that I think that what the single biggest investment mistake I see people making is they want to construct their portfolios to be timely. And if you are trying to identify what is timely, you are looking in the rearview mirror at what has already happened. I think what we bring to the picture at the core of a portfolio, not 100% of somebody's portfolio, but at the core, is a timeless component that the investor understands. I've had so many people tell me this year that we did exactly what we said we would do. That is the timeless component to a portfolio. And I believe truly around that you can build timely satellite components to that, whatever you think those timely things may be. But if you have a timeless core, then volatility, Billy, as you said, is an opportunity because you understand what you own and why it's behaving the way it behaves. It doesn't mean it behaves like the market. In fact, we often behave nothing like the market in the shorter run, right? But over time, there's a real correlation between us and the S&P 500, just not necessarily today. Anybody have issue with that?
No, I think that's a good point. I mean, I think that at the end of the day, how does Tandem navigate volatility? Well, we navigate it by finding companies that can consistently grow their earnings, their sales, their cash flow through any sort of economic environment. And if they can't do that, we won't own it, right? And so to me, that's why it's timeless, because what is it? Global trade war, global trade uncertainties. Well, guess what? Our companies need to grow through that or we won't own them. Is it a global pandemic? Well, they need to grow through that or else we won't own them. Is it the financial crisis or the bursting of the tech bubble or just a run-of-the-mill recession? It doesn't matter. Our companies need to have that consistent growth or we just won't own them. And to me, that is always the answer as to how do you navigate this and how do you position yourselves or any of that. The answer is always the same, which makes it a boring answer sometimes to give, right?
Never.
But yeah.
I like that. I would just add that because of the nature of the businesses that we seek to own, they don't always look like the market, right? I mean, sometimes when a new technology emerges, like the internet in the late 90s or AI now or whatever the case may be, those things are fueled by investor enthusiasm. And there's rarely investor enthusiasm for a waste collection company, right? I mean, but that doesn't make it a bad business. And so it can look very different than the market in periods of euphoric growth. It can also look very different than the market in periods of doubt and uncertainty and fear and panic. And I think one advantage we have in constructing that type of portfolio is that it is less sensitive to what's happening now, and it is more based on just a fundamental story that lasts through any economic environment.
Yeah, and like any market, sometimes it's going to appreciate those stocks, and sometimes it's going to underappreciate those stocks. What does make us different in that is we do follow the same discipline throughout. And so getting caught up in the latest fad is not part of that discipline, which leads to the consistent, repeatable results, right?
Yeah.
So one of the things that I like to say, and if anybody listening to this has heard me speak in public, they've probably heard me say this, but I like to borrow Mel Gibson's line from The Patriot, aim small, miss small, right? A lot of investors approach this from a macro viewpoint, very much from top down, where they're analyzing the environment and if not making predictions, at least making assumptions. And I think it's very difficult to have an opinion about an economy, whether it's a nation's economy or a global economy. I think it's a lot easier to have conviction about a specific company. And I think that's kind of how we fall. Mm-hmm. Jordan, are you still awake down there?
I am.
Okay,
I am.
just checking.
I think that's even more true in an environment like this, though. I remember in October of 22, for example, 100% of economists polled by Bloomberg at the time, 100% said that we would be in a recession in 12 months. That was so wrong at the time. And so I think that if you had positioned your portfolio that way at the time, you would have regretted it. And so when you are taking that top-down view of, should I be in this market? Should I be out of this market? Or if something really bad is happening in DC that I don't agree with, you can stand to really put yourself in a painful place, I think, if you get that decision wrong.
Yeah, there's the consequences of getting a macro decision wrong, I think, are far greater than the consequences of picking the wrong company, right? We own, depending on our strategy, somewhere between 26 and 39 names in a portfolio. Mm-hmm. Yeah, no doubt we've gotten a couple of those wrong, but that's far less impactful than building your portfolio around the expectation
And
of
exiting the market in October 22 and getting that wrong is way more painful than getting one or two stocks wrong in a portfolio, for sure.
Our job is to help keep clients invested through any market, right?
Correct.
Yeah. All right. I am coming to the end of my notes, but before I do, I noticed that Jordan and Ben both have a collection of notes in front of them. Billy needs no notes because he has an encyclopedic recall of all things. So why don't we just pause for a second before we put a bow on this? And Jordan, I'm going to start with you. Is there anything that you had come prepared with today that we didn't touch on, or anything that you've heard today that you think we should add to or explain further?
Yeah, I'm glad, John, that you mentioned that our goal is to keep investors invested. I think Ben touched on this in the latest Tandem report. But when volatility spikes, the moves in the market can be really great to either side, right? Both to the upside and the downside. And a lot of the time when, volatility is spiking, panic sets in, and people want to just get completely out of the market, right? But if you look historically, the best periods of performance in the market tend to coincide with the worst periods in the market, right? If you look at, performance in April, I think it was one of the strongest 21-day stretches of performance since 2001, 2002, 08, 09, and then again coming out of COVID in 2020.
You're talking about for the S&P, right? Mm-hmm.
For the S&P, okay. That's right. So if you get out of the market whenever, there's big swings near the lows, it's likely that unless you flip right back in, which most of the time tends not to happen, that you're going to miss out on some of the best days of performance, right? And you'll likely get in much higher than where you got out of, which is the opposite of what you're supposed to do, right? And Ben, remind me, but I think the way that you put it is, we always say the mantra is, time in the market, not timing the market. And it's just really difficult if you're trying to flip in and out of the market to capture those big days.
Well said.
You, sir? Billy?
I didn't come prepared. Really?
No notes.
And you're going with that?
No notes.
Okay.
The only thing that I would add, we spend a lot of time talking about keeping people invested. And we've always sort of broken that down into two pillars. The first pillar for us is delivering a more consistent, more repeatable, and less volatile investment experience. And that's what we spent the majority of today talking about. The other piece of that pillar, or the second pillar, is buying low and selling high. And we definitely did that throughout this year so far, year to date. We were putting a lot of cash to work throughout late March, early April. I think in our equity strategy, we spent cash down from about 18% to about 5%. That's a lot of cash that we put to work buying that dip and buying low in that strategy. In large cap, cash went from about 20 to about 15. Not as much opportunity, but not as much volatility within that portfolio versus the market as well. And then I think that we put somewhere between a fifth and a sixth of the cash that we had in mid cap to work as well. So to me, that is buying low. And that's what we were doing throughout that volatile market.
So I just want to touch on this for the listener who's just coming to us recently and hasn't heard this story ad nauseum. How is that different from market timing?
Yeah, sometimes it sounds like market timing when we're talking about it, right? Because we're talking about the market being at lows and we're putting cash to work. But market timing, in my opinion, takes that top-down outlook that we were just talking about, where, now's a good time to put money to work, so I'm going to go out and spend 5% of the cash in the portfolio. That's not at all what we're doing, right? Every decision that we're making is at the individual stock level. So our model, our quantitative model, which is how we remove the emotion and the bias from our process, says, now's a good time to go buy stock ABC. Has nothing to do with the market, has everything to do with the signal that we're getting in that stock. And when you're getting more signals to buy than you are to sell, what's going to happen to the cash levels in the portfolio? It's going to drop, right?
And in ordinary times, we get very few signals, right? We'll get a signal for a stock that looks cheap. We'll get a signal for a stock that looks expensive. It's basically a non-event. But in periods of heightened volatility, when stocks tend to move in the same direction together, right, you get more of those signals.
Yeah, I think anytime correlations go to one, which is sort of what we saw, it's a way to say everything is selling off, right? You'll tend to see new names enter the portfolio. Again, not because we're timing the market, but because we're finally getting signals that we've been waiting on. And that was true through each of the past sell-offs as well. You saw a number of new names enter the portfolio in 22. You saw a number of new names enter the portfolio during COVID. And this time was really not that different.
And Ben, you touched on how aggressive we were on the buy side and on the strategy level, but also for new accounts and new money. I think at the start of April, we had put 50% of a new account or new deposit to work within a week, right? So just wanted to plug that in there. That also, as we're transitioning portfolios to our strategy, we tend to accelerate that transition during periods of heightened volatility as well.
Yeah, that's right. In our manager traded portfolios, activity was definitely picking up at the transition level. It's since slowed down, right? As you had the strongest recovery, Jordan, that you had just mentioned since 25 years or whatever. There's been less opportunity over the past week or two than there was 4 to 5 weeks ago in those manager traded portfolios.
All right, very good. Thanks, guys. I think it's time to wrap up. Before we do, I want to just sort of reminisce for a moment. This is our 5th anniversary, and each one of us have been here for every podcast, and we've come a long way from the day 5 years ago that we sat around a round table in my office, and Elaine dropped an iPhone in the middle of the table and said, "Go." She said, "People need to hear these conversations that you're having." And that was episode 1. And the iPhone, curiously, is just as important today as it was then, except for today, they are the cameras that you may or may not be watching us through. And so I thought it'd be fun to just go around the table here and see if anybody, I didn't give you this in advance, so if you have nothing, that's okay. My money is on you having nothing, Billy.
No, all I was going to say is with all these lights and everything, I kind of want to go back to the iPhone on the middle of the table. Not gonna lie.
Well, then we do not have the same favorite podcast memory, but I was just going to ask what your favorite podcast memory is, each of you. Billy?
Number one.
Number one. Jordan?
No, I guess just the evolution of how far it's come. I remember sitting in Ben's old office on, this side of the office over here, which is now 2 different offices, right? And we had the phone on the round table in there, and really how far it's come, the evolution of it with the microphones now. And now it's almost like we're in a studio recording this. So it's been a fun ride.
I'd say the same thing. I mean, it's just been fun to see the growth of it. I think the first one was probably an hour and a half, and was really long. And I think that we've hopefully cut that down significantly, which makes this easier to digest and easier to listen to. But it's been a lot of fun.
Well, I would have to say my favorite podcast memory is this one because I don't remember the first 19. Lindsay Collins, I want to sincerely thank you for bringing this to us. You've been our great sound person and voice. I confess I don't know for how long, but I think a few years now. And you brought the cameras and the lights and your crew, Elizabeth. Thank you very much. You brought this guy over here in the corner, Jeremy Croft. If any of you have ever done a Zoom with me, there's a painting that sits behind me of a beautiful trench coat against what's the color of that background, Jeremy? Light English red background, which I just love. And Jeremy is the artist that painted that picture, which if you ever visit us, you will see. So please do come visit us. But I want to thank everybody. Elaine, thank you for the brilliant concept of thinking of this. You were Elaine Natoli at the time, but you are now Elaine Carew, and I'm extremely pleased about that. Ariel Davis, you are tremendous in your support of this ongoing episode, and I would remind everybody that this podcast, or is it now a vodcast?
Here we go.
Okay, I don't know. Whatever this is, it's available on our website, tandemadvisors.com. It's also available as a podcast for streaming and download on Apple Podcasts, SoundCloud, Amazon Music, and Spotify. And if you want to see these 4 ugly mugs, go to our own YouTube channel. That's new stuff. That was something completely different. Until the next time.